Hi, I'm Eddie Schultz. I work for Texas Municipal Retirement System in Austin, Texas. I am the portfolio manager overseeing real estate and real assets, which covers the full gamut, covering natural resources, energy, and infrastructure, of course, infrastructure being a large part of what we do at this point. Today I'll be talking a little bit about valuations, cost of capital around the industry, the things that I see within the industry as I partner with different people being a new entrant into the infrastructure space. I think that one of the larger issues that we face at TMRS as we've gotten involved is that infrastructure really isn't one space. The reality is that it's a number of different sectors, not only from an investment perspective, because you're looking at everything from midstream to transportation, but the investors aren't the same. Coming from sectors that are traditional for pension funds, things like private equity and real estate, where for the most part, each institution has the same objectives. In infrastructure, they're quite different. I've noticed as we've kind of gone up the food chain, 5 years ago being a new entrant and kind of doing the traditional commingled private equity fund structures and trying to get a little bit more creative to create some more efficiencies, we're now competing with other types of LPs, other types of investors, and the biggest difference being not only their strategies, but just their cost of capital. And one of the key things that we saw internally when we first started in this space was the large wave of bureaucratic capital that was coming into infrastructure. The number of pension funds that simply had core fixed income that wasn't performing and needed to get that money put to work saw infrastructure as an alternative. And it created a lot of money out there. We consistently asked the question to infrastructure managers, why isn't this simply just a capital flows game? 5 years ago they were targeting 13, 14, 15% returns. Today that's 10, 11, 12. And to us, it's simply a matter of valuations. And the valuations don't necessarily have anything to do with fundamentals in our perspective. They have more to do with the fact that you have lower costs of capital coming into the industry. You have the Canadians who are strictly focused on sort of the core and super core space. Now you have commingled funds being started in the super core space. To us, it creates a distortion in the risk-return profile for infrastructure. You're seeing a large aggregation of return profiles within the industry. You're seeing people at the very low end in the 4 to 7% range, which tends to boggle my mind when people start talking about 5 and 6% returns. And even the sort of alpha-generating value add, or as infrastructure likes to call it, core plus, apologies, you're still looking at high single digits, low double digits. And the reality is today, the high valuations really sort of hide the reality of the risks people are taking. And we're talking, even when you talk simply about true infrastructure, transportation, midstream, things people can agree on are hard infrastructure, things that are necessary to society. Not even speaking about the extended areas like telecom, where you can argue about how much infrastructure-like characteristics they have. The reality is today, most of these things carry more risk than people realize. Most people are looking at them and simply saying, bond-like risk, equity-like returns, I like it, I'll go into it. The reality is they don't really have bond-like risk. You're taking equity risk in infrastructure that frequently has minimal numbers of off-takers or counterparties. You're going into something where if your counterparty is lost, you sort of lose your piece of infrastructure. I mean, the classic example of this is the Indiana toll road that was GDP correlated, so a little bit different. But today, I think most investors have gone into the infrastructure space with a large amount of capital, increasing valuations, and ultimately have increased the value of the assets in sort of an artificial way. The fundamental underwriting of infrastructure shouldn't have changed, but it's simply a capital flows game. There's more people to invest, there's more infrastructure managers out there to invest it, and more than happy to increase their AUM or just start their business. And so it creates a misalignment of interests, and everyone just simply comes up with a justification as why the valuations make sense because they're safe and happy infrastructure, when in reality, the risk doesn't justify the increased valuations. So that's my overall take on the system. It's not bright and rosy, but it's a necessary space. Infrastructure is a new opportunity for institutional investors, and like I said, with the changing fixed income markets at the end of a 35-year bull market, you have to find a place to get your returns because you have to cover your liabilities. And infrastructure can do that. But I do think it's in the early stages of figuring out what its role is going to be in people's portfolios.